Well, good morning, everyone. My name is Gary Martinez. I am a member here of the Breakfast Club, and I'm very excited to have everyone here this morning, along with my boy, Justin Lacey. Very excited to have everyone here, and can't wait to see everyone in person. And I know we're starting to get out there a little bit slowly, but I can't wait for the day again we could hang out together. But Breakfast Club, overall, what we do, we basically have two goals. Our goals are networking along with education. And so what we want to do is provide the most dynamic speakers we potentially can, for our organization to help you with your goals for your business and ultimately help you grow your business. The other thing we do is networking. We want to try to introduce to people that everyone get a chance to meet each other and also help grow each other's business through the relationships. And so just want to also introduce our committee members. We have Mr. Mitch Woolley. We have our fearless leader, Mr. Vernon Webb. We have Denise Anthony, along with Margaret Brown. And so I want to thank them all for their services and for all their help and support, because there's no way we could do the things that we do without each of their help and support. So with that, welcome everyone this morning. I'm going to pass it off to Mr. Mitch Woolley.
Thank you. Good morning, everyone. Well, we have a really, really unique program for you today. We have a panel discussion, and we have not one, but two speakers. I'm going to introduce both of them briefly, and then I'll read the bio on the first speaker, and then when we get ready to the second, I'll read the bio for the second speaker. But our two speakers today are Justin Lacey, who is Vice President and Resident Director, also Wealth Management Advisor for Merrill Lynch, and Kevin Jackson, who is an attorney at law. He's an estate and trust attorney. So those will be our two speakers today, and we're going to go first with Justin Lacey, who started out at Merrill Lynch as a financial advisor in 2017. He focuses on working with executives, attorneys, physicians, business owners, and families in designing strategies to help them enhance, preserve, and transition their wealth. Mr. Lacey graduated magna cum laude from USC, where he double majored in business administration and accounting. His previous work experience includes Deloitte, Goldman Sachs, and UBS. He holds the designations of CFP, which is Certified Financial Planner, CPA, Certified Public Accountant, CPWA, which is Certified Private Wealth Advisor, and more importantly, a AWMA, which is Accredited Wealth Management Advisor. Justin Lacey is a member of the Bank of America Black Executive Leadership Team and USC Leventhal School of Accounting and Public Media Group of Southern California. Ladies and gentlemen, let's hear from Mr. Justin Lacey. Justin?
Thank you, Mitch. Thank you, Gary, for the introductions. I'm going to attempt to share my screen. We did some practice on this, so I should be a veteran by now. So give me, Mitch, give me a thumbs up. We looking good? Oh, yeah. Okay, cool. All right. So as Mitch and Gary mentioned, I'm a wealth management advisor. I work at Merrill Lynch, based in Newport Beach. I live in Long Beach. I've been a City Club member for the past 6 years. So it's a pleasure to see familiar faces, it's a pleasure to meet new faces. And this presentation, I'm going to spend about 15 minutes on it before I transition it back to Mitch for then Kevin to go through his presentation. But this presentation is going to be focused on investing fundamentals, helping you make educated decisions. And the seminar is designed to help you better understand the basics of investing used by nearly all investors. So I'm going to run through this presentation, and then once myself and Kevin go through our presentations, we'll then open up the floor for Q&A to be able to answer any questions you have as relates to your own personal questions or circumstance. So you may have some questions about investing, right? Why is investing important? What kind of investments are available? How do I choose investments? How do I manage my investments? So understanding the basics of investing, it's central to financial wellness. Going to the next slide. So inflation. So I don't know if you have been reading the headlines, but everyone is talking about inflation, right? Prices getting more expensive, right? So let's start with a discussion on the importance of investing as it relates to inflation. So, one of the reasons investing is key to financial wellness is that it can help your wealth keep up with inflation. You would need almost $20 today to have the same buying power that $10 had in 1990. So think for a second how much money you think you'll need in 30 years to have the same buying power you have today in 2021. Another reason investing is central to your financial well-being is that you may live for a very long time. My grandma passed away at 98 years old. I have another grandma who's 92 years old, who's kicking, who moves around like she's 62 years old. 1 out of 3 males and 1 out of 2 females who are in their 50s today will live to be 90 years old. It is important to not outlive your retirement savings, and nearly a third of all households nearing retirement have no retirement savings at all. Now, Merrill estimates that you'll need approximately 90% of your pre-retirement after-tax income for each year you'll be retired. So you're going to need some good amount of money. So planning ahead for your retirement years is extremely crucial. So now that we know investing is such an important part of your overall financial picture, let's go over what kind of assets you can typically invest in and how to do so. Relatively simple. So the 3 main asset classes you can invest in are stocks, bonds, and cash equivalents. And we'll discuss in this presentation, you can invest in each of these pretty easily through things like mutual funds. But understanding some basics about each asset class can help you choose a mix of investments that makes sense for you. Stocks represent ownership in a company. They generally offer the highest potential for return, but also the highest risk. Keep in mind that stock funds will fluctuate in value and are not guaranteed and have been more volatile than other asset classes. Bonds essentially are loans to a company or government body that promises to repay the loan, usually with interest. These debt securities generally offer modest potential for return and moderate risk. Please note that with bond funds, return of principal is not guaranteed. Bond funds have the same interest rate, inflation, and credit risk associated with the underlying bonds. And generally, the value of bonds rises with prevailing interest rates fall, and the value of bonds fall when prevailing interest rates rise. So everyone's talking about right now, we feel like we're in a rising interest rate environment. We think the Fed is going to increase interest rates. If the Fed does increase interest rates, we'd expect bonds that people own through mutual funds or outright to decrease in value, and if that were to be the case. And then lastly, cash and short-term debt securities, their potential return is generally low, and their risk is low as well. So how can you invest in these asset classes? The easiest way to invest in stocks, bonds, and cash is through mutual funds, or similar types of investments, such as the ones offered by your company's retirement plan, like your 401k or 403b. Mutual funds can help simplify investing. They pool money from many investors and invest toward a specific objective. They're managed by investment professionals who choose the individual stocks or bonds to be included in the fund. They generally invest in many different stocks and bonds based on their objective. This means you get exposure to all the investments the manager has selected, and that's why mutual fund helps spread out your money over a whole bunch of different investments. But in most cases, you'll want more diversification than what a single fund may be able to provide by itself. So there's active funds, there's active mutual funds, and then there's passive like mutual funds and index funds. Let me explain to you the difference. And you can choose between the two of them. So actively managed funds seek to outperform the benchmark index, right? Managers make investment decisions, and they generally charge higher investment fees. And these mutual funds are, as I mentioned, trying to outperform a benchmark. So let's take the S&P 500 as an example. S&P 500 is a benchmark. It's the 500 largest companies in the United States. Anyone can Google S&P 500 companies and see the 500 companies listed. So an actively managed mutual fund, they're going to probably invest in like 50 or 100 of those companies, and they're saying, hey, we have the wherewithal and expertise to choose the 50 or 100 best. We're going to try to just choose those and exclude everything else, trying to outperform the benchmark, right? Inversely, passively managed funds, typically indexed funds, right? Index funds has been a big name now. Those tend to be cheaper because the portfolio manager is just trying to replicate the benchmark index. So using that same example, if the S&P 500 is the benchmark, the index manager is probably going to invest in those same 500 companies in the same percentages just to get the same return as the benchmark. Now, what affects your decision in terms of, what percentage of stocks and bonds and cash you should have, and should you have index funds and mutual funds? It really falls into 3 different categories. Your goals, right? What you're trying to accomplish going forward, your time horizon, how long that money is going to be able to work for you, and then your risk tolerance in terms of how much risk are you willing to bear with the investments that you have. So why does time horizon matter, right? With more time on your side, you likely can be more comfortable with investment risk, right? So you might consider a more growth-oriented mix of investments, more in stocks if you know you have a longer time horizon, right? In your middle years of your career, you may have less time for retirement. So you may want to gradually add more mixes of bonds and cash equivalents and a little bit less in stock, right? And so on and so forth as you get later and later in life. So this kind of tracks where the different funds are relative to their risk and return. So you'll see at the kind of the furthest, the highest, we tend to see potential highest return as well as risk in international equities. Equity is the same as stock, so international stock or international equity funds. And then obviously on the far left, you see, cash and cash equivalents, right? So it's important to, know the types of funds that you have and where they plot in terms of potential risk and potential return. Okay? As Warren Buffett once said, our favorite holding period is forever, right? The goal of investing is to not pick a stock that you say, oh yeah, like people are gonna be working from home for the next year, let's purchase Zoom, now. Like that's a bad way to go about thinking about it. The best way to think about it is, hey, what is a stock or what is a position or a fund that I have conviction in, not holding for 1 year, not holding in 5 years, but for the next 40, 50, 60 years, right? Passing on to my kids or my niece or whatever it is, right? So that's how you should think about investing is what do you have conviction in, not holding not only for the short term, but investing and holding on for the long term as well. Okay? So things to remember. So we talked about time horizon. So now talking about volatility. What I want everyone to remember, what I want to try to emphasize the best of my ability is volatility is normal, right? This Monday, the stock market was down by like 2%. I didn't have any clients that called me were concerned because I've coached them on volatility, but I talked to other friends that were like losing their pants about it, right? Volatility is expected. The S&P 500, which is the benchmark for the 500 largest companies, right? On average, there's about a 10% drop in the S&P 500 some point during the year, about once a year, right? In terms of a 5% drop, that tends to happen between like 3 to 5 times a year, right? So drops in the market are normal and to be expected. And a lot of times they're healthy because if the market just is running with growth every single day, eventually something's going to give, right? So volatility is normal, and just understand that. And don't get too warped up on the headlines, right? CNBC, Fox News, all that stuff, they get paid based off of eyes to the TV. And what we've learned through behavioral finance is that people care a whole lot more about potential issues and red flags and market drops than they do about when people say, yeah, things are looking well and the economy's doing well and the stock market is growing. That doesn't captivate audiences. What captivates audiences is fear and scare that the sky is falling down and their investments are going to go to zero. So try not to pay too much emphasis on daily headlines. Just keep a long-term approach. Keeping in mind that, hey, if your position drops by 10% in one day, you lost money, but you just lost money on paper, right? It's only you selling locks in that loss to make that loss real, right? So don't get caught up in declines and don't automatically sell because then you lock in a loss. What we always emphasize as financial advisors is the ability to always want to sell high and buy low. And it sounds so easy, but it's much harder in practice, right? So always kind of keep that principle in mind. And market timing is usually a bad thing. Trying to wait until there's 100% sign that the market is going to be great and the recovery is on the way, you're probably going to miss out on a lot of potential gains. So many of the best days of the market have taken place in rough, what we call bear markets, right? So looking to try to find for every single thing in the economy to show as a positive and plus sign to invest your money is usually a recipe for missing out on potential gains. A couple other principles on investing are diversification, asset allocation, periodic review. So diversification, as we mentioned, that's having a mix of stocks, bonds, and cash. It's within the stocks having a mix of international, U.S., large U.S., small U.S., right? So we talked about that. Asset allocation we talked about, and periodic review is saying, hey, you need to, on a consistent basis, look at how your accounts are invested, see if there's been any significant changes in how you originally wanted to be invested in terms of stocks, bonds, the cash percentages, and make any adjustments that need to be made at that point in time. My man just looking at me from the outside. He sees this ring light in front of me. He's like, what is going on in there? So why is asset out? I'll skip ahead to the next couple slides. So I like this slide a lot because what this shows are different stocks performances in each year, right? So like let's follow U.S. large cap growth. So U.S. large cap growth is considered as LG. So you'll see it was up 44% in 2009, right? It was like it's like doing really well in 2014 to 2015 at the top of the pyramid, right? So more times not been really high, but there are also years where it did really poorly relative to other asset classes. In 2008, U.S. large cap growth was down 41.9%. That was the second worst performer out of all asset classes, right? So trying to pick just one box or one asset class and say, hey, I'm going to invest in this every single year, it's not a good strategy because you never know if it's going to end up at the top or in the bottom. So what we always recommend is have a diversified approach, which are these kind of gold boxes right here that have the lines through it. That's diversified. We're having a mix of all of them where you're guaranteed to not finish at the bottom, right? And yes, you know that you're not going to finish at the top because you're diversified. However, finishing in the middle on a consistent basis is the best way to have your money consistently grow over time. Okay. And then in terms of rebalancing, so rebalancing is extremely important, right? I mean, you can have a financial advisor or be yourself comfortable with having a 60% stock and 30% bond and 10% allocation. And if you invest in that way, if the stock market does well for a year or two, that 60% stock allocation can now be 80% because the stocks did well. So it's important and prudent for you to continue to look back at your allocation, make sure that it still is where you'd like it to be, and make any adjustments to get it right and fine-tuned based on your asset allocation strategy going forward to accomplish your goals. So I wanted to run through that, and I wanted to emphasize, so, having an investment, people think of me as a Merrill Lynch financial advisor, like, hey, that's Justin, that's my advisor. He helps me out with all my investment decisions and puts together a right investment strategy for me, make sure that I'm diversified and I have the right time horizon, knows my risk tolerance, and build strategy along to help me accomplish my goals. That is 100% what we do at Merrill Lynch and what I do as a wealth management advisor. But I'll tell you this, investment strategy is extremely important for your financial goals, but crossing your T's and dotting your I's on all those other areas of advice beyond investing are equally important to help you get to where you want to be. So that's that's making sure that you're maximizing your cash flow and retirement planning, right? That's making sure that you're investing enough on a consistent basis. That's making sure that you understand the different investment vehicles you can invest in, like a 401k, an IRA, a brokerage account. You're taking advantage of those contributions. That makes sure that you're looking at your mortgage and looking at potentials to refinance and save a little money on interest rates. That's your estate plan that Kevin's going to go into. That's all the insurance coverage you have, like life insurance, long-term care insurance, to make sure that's dialed in right. So the key to investing success, investing is definitely a part of investing success and financial success, but there are so many other components that are just important to having a great investment strategy to help you get from where you are now to where you want to be. So I'll stop there and I'll kick it back over to Mitch to then be able to introduce Kevin, and I'm happy to take Q&A after Kevin's segment.
All right, thank you, Justin. I actually have a couple of questions. I put them in the chat box, but I'll read it out to you. The first one is, do you recommend investing regularly and consistently versus trying to time the market?
Yeah, so like I said, no one knows how to time. No one has shown the ability to accurately time the market. What people fail to recognize a lot of times is that in order to accurately time the market, not only do you have to be correct about when you pull your money out, you also have to be on point and correct about when you put your money back in. And to be able to accurately predict both of those at a high level is nearly impossible. That's why Warren Buffett doesn't do it. That's why all the famed investors don't do it. So I highly recommend you having an investment strategy that you're comfortable with, where you're not taking on too much risk, where you can be able to stomach the losses you may have in your investment portfolio to keep your money invested over time, right? There's no better holding period than forever, as I mentioned, as Warren Buffett. So that's how you should treat your investments, is trying to have a strategy where you can keep going forward regardless of where the market goes.
Good information. Thank you. It gives me something to take back to my wife. My wife listens to some of her friends sometimes, and she'll come back and say, we need to sell some stock. And I say, why? And she says, because my friend told me the market's going to go down. And I go, well, it's going to go down and it's going to go up and it's going to go down. But, and that timing, and I know the answer to that. I just wanted to kind of throw it out there because of a real world experience with my wife trying to give investment advice, and her friends that are doing it don't even own any securities at all. So, which makes it a little more challenging.
Yeah, and that's really why time horizon is important, right? I mean, when people ask me, hey, Justin, I want to put some money to work, but I'm going to need it in the next year or two, I tell them I'm not we're not investing that money, right? Like the money that I have conviction putting to work and putting in the market is money that's going to work for individuals for 2+ years, right? Because the probability of the stock market being up in any given day is 50%. The probability the stock market is up in a year is about 70%. The probability the stock market is up over 5 years is 85%, right? So the longer the time horizon, the higher the probability that that money is going to grow in that time period. But I refuse to put money in the market for a year because now we're no longer investing. We're now gambling. And you could just as easily go to Vegas where I'm going on Friday and put that money on Red 3 and see what the result that you get from that.
Good point. I added another thing, a comment in here. We were talking about the losses and things like that. I think that a couple of years I had really big gains and I needed to offset it. And I had some stocks that weren't doing really well. So I actually liquidated them in December so I could take a loss because I needed that loss to write off because it was just a paper loss anyway. But I didn't want to pay the taxes. So is that appropriate?
So one of the designations that's not included behind my name is CPA. I can't hail myself as a CPA for compliance reasons, but I am a certified public accountant. So I understand the value of tax minimization. And the way that I advise my clients is helping them maximize their after fee as well as after tax returns. So having a tax minimization strategy as a part of your investment strategy is extremely important to help you maximize your gains. And yeah, what you're referring to is called tax loss harvesting, where basically if you've sold, so let's take a step back. If you sell investments in a gain that are in retirement accounts, you do not have any tax implications for that. So if you bought Apple and Apple grew $3,000 since you bought it and you sold it in your IRA or your 401k, there's no taxes that are realized from that. So you can do all those trades in your retirement account and have no taxes. However, if you have a non-retirement brokerage account at like a Merrill Edge or one of our competitors, right? You can invest in Apple on a non-retirement account. It grows in $3,000 in value. You decide to sell it because you say, hey, Apple's not going to go any further, and you then have to pay taxes on that $3,000 of gain, right? So what you can do is you can sell Apple, realize $3,000 of gain, but see another position, call it Ford stock, where maybe the loss you were down $5,000, and since you put money in Ford, sell that Ford position and use that $5,000 loss to net your $5,000 loss in Ford to go against your $3,000 gain in Apple, and no longer have a gain and actually have a loss you can use to bring down your ordinary income expenses. Now, any tax advice, I don't give tax advice. You always talk to a CPA. Let me put that out there, especially because it's recorded, right? But there are tax planning strategies you can implement as a part of investment planning as well.
Good. And answer the question very well. That was outside of retirement, by the way. Another question, what are your views on virtual currencies? Been thinking of starting a small pot of ETH.
Of what? What was the last?
ETH acronym. I don't know what that is.
I think that's Ethereum, right? That's probably Ethereum. Yeah, Kevin's nodding his head. So the fourth category that I didn't talk about, there's stocks, there's bonds, there's cash. The fourth category is alternative investments. And those traditionally, pre-2015, those were thought to be like things like investing in private real estate, right? We have a real estate manager that goes out there and buys like commercial or residential property. That could be like hedge funds. That could be private equity where you're investing in non-public funds that you think are going to become public, right? So those are alternative investments, which we recommend having some if you are qualified and able to invest in those things. Within that alternative investment universe now fits the digital currency, now fits the Bitcoins and the Ethereum, things of that sort. So I think that it makes sense having investments that tend to perform a little bit differently than stocks in your portfolio. So I wouldn't recommend having a client have more than 20% of their assets in alternative investments, but having a portion of it in some of these things that can boom or bust could be appropriate for you. But I'd definitely recommend talking to like a financial professional, talking to someone that's more aware of like the digital currency you're looking to invest in to understand if it's right for you. But one thing that's for sure is that if you do invest in that digital currency, you need to be able to have a, strong and aggressive risk tolerance. That is not something where, where you can invest in and be phased if your portfolio, if that investment is down by 10%, because that is a very much a reality that can be down 10%, 50%, 20% in a single day.
So that's more of a time horizon thing. If you have a short time horizon, probably stay away from it.
Yeah, like I said, if you have a short time horizon, if you have a time horizon under a year or two, I don't recommend investing in anything outside of just having a cash position.
Got it. Cool. Finally, I had another question. So my wife and I have health savings accounts with a lot of money in them. And we have a basket of mutual funds that they're invested in, and they were equally, the money was equally dispersed amongst all those 8 funds. And these are institutional funds, so they're not available to the public because they're typically a $500,000, $1 million buy-in, and usually institutions are the ones that buy them. But this is through Optum, which is United Health. And anyway, 2 of those are consistently outperforming for the last 3 years, are consistently outperforming all the others. And when you look at the pie, the allocation pie, you have these huge big wedges for these 2, and everything else is kind of shrunk. And the same exact dollar amount was in all 8. What I was thinking about doing is maybe taking the 2 that are mostly the laggards, the smaller ones, and reallocating that money into the bigger ones, just to kind of compound things a little bit. What are your thoughts on that?
That's a great question. So let's back up for a second, just for everyone's on the same page. So a health savings account is basically an investment account that you can create with your employer if you're enrolled in a high deductible health plan. If you're in a high deductible health plan, they say, hey, because you have a high deductible for having this health plan, we'll allow you to create an investment account where you can put money in there. And the first between $500 to $1,000 has to be kept in cash, but anything above that can be invested in the stock market and grow. And for people that are healthy, that tend not to go to doctors a lot, HSA compared with high deductible plan can make a lot of sense. So that's what Mitch is referring to. So within the allocation of your HSA, you really want to look at, the asset allocation of those 8 different funds, right? So for instance, over the past 5 years, U.S. large cap equities, which are really big U.S. companies, have outperformed basically all the other asset classes, right? So if you're comparing 2 funds that are U.S. large cap funds compared to international funds and bond funds and all that stuff, you're going to see a big outperformance, right? Because that asset class has just been in vogue and been in favor over the past 5 years. What I would recommend you do is look at the different allocations that you have in the other funds and compare those funds to their benchmark, right? So compare the other stakes that they're in, large international companies, bond funds, whatever it is, compare those to their own benchmark index, which is going to be included in the information you have on the investment choices, and see how they're doing. If they're outperforming their benchmarks, so you know that the managers are actually doing a great job based off of what they can invest in, and to make sure that you have a diversification asset allocation that makes sense for you. So that's my kind of long-winded way of saying, hey, first look at how those funds that you consider laggards are comparing to the actual benchmark to see, hey, maybe they're actually doing better than the benchmark is doing, and then make sure that the asset allocation that you have makes sense. If you say, hey, we can take a lot of risk on this, we're not touching these funds for a lot of time, then maybe you redirect some of the less risky funds with lower growth potential from those buckets to the funds that you have. And also take a look at the funds you think are really crushing it, because I've seen situations where, their best performing fund, right, U.S. large cap growth, were the best compared to their 6 alternatives, but compared to the benchmark, those 2 best performers were actually trailing their benchmarks by 2-3%. So maybe they're not even the best funds within your lineup, but they've just been the best funds from your invest positions based on allocation. So
sure, yeah, thank you. Yeah, because they're international, they're large cap, they're small cap, like Russell 2000, stuff like that. So yep. I mean, it's all over the place. So I'll have to go back and compare it. But I don't.
So don't try to compare apples to oranges. Only compare apples to apples.
Yeah, good advice. Good advice. Thank you. Thank you. Are there any other questions, guys? All you investment professionals, come on. That's it. All right. Thank you very much, Justin. Really appreciate it.
No problem.
All right. So let me introduce Kevin Jackson. So Kevin Bryce Jackson represents fiduciaries and individuals throughout California in a wide range of trust and estate matters, including estate planning, trust and estate administration, trust and estate litigation, and civil related civil claims. Kevin graduated magna cum laude from Cal State Long Beach. He obtained his law degree from University of San Francisco Law School, where he received academic honors during his 3 years of attendance. While living in the San Francisco Bay Area, Kevin served as adjunct law professor at University of San Francisco, where he taught estate planning. Kevin's currently serving a 2-year term as the Young Lawyer Liaison to the Trusts and Estates Section Executive Committee of the California Lawyers Association, which is formerly the California State Bar. For the past 2 years, he has been selected by Super Lawyers magazine as a rising star, and the State Bar of California has recognized him with the Wiley M. Manuel certificate for his commitment to pro bono legal services. Kevin's married in the process of relocating to Southern California. Ladies and gentlemen, please help me welcome Kevin Bryce Jackson.
Thank you, Mitch, and thank you everybody for having me. I'm excited to talk about my favorite subject, estate planning, which might not be everyone's favorite subject. And I'm going to go ahead and try and share my screen. So. All right, can everyone see that? Perfect. So, as Mitch said, I am a trust and estates attorney here in California, and I have clients in Northern and Southern California. I just spent 7 years in Northern California, exclusively practicing trust and estates. And as of next Monday, I'm going to be relocating to a firm in Century City with offices in Orange County, originally from Los Angeles. So my wife and I just decided to return home. And so again, I practice exclusively in trust and estates. And for those of you, asking what that actually means, trust and estates, what I essentially do is I help my clients handle assets. In the estate planning context specifically, I'm basically helping people preserve and transfer their assets to the next generation through executing strategic estate planning documents. And everyone's trying to build wealth, and we build wealth and we amass this pot of assets, and we call it generational wealth. But it's not really generational wealth unless we actually pass it to the next generation. So before I go any further, I just have to do this as an attorney, disclaimer, of course. So I just want to make clear that I'm going to be speaking in generalities today about estate planning. So this isn't going to be legal advice from me to you. What I say is intended to basically be a general overview and discussion of the subjects discussed, but I won't and I cannot go into anyone's specific circumstances. And me discussing the estate planning doesn't create that lawyer-client relationship between me and any of the guests. And what I say is not intended to be, and you shouldn't construe it as actual legal advice. So I'm just going to answer basic questions. You should certainly consult an attorney, me, or you can contact me. I can refer you to someone, and then you want to craft your actual specific estate plan. Other caveat is I'm licensed to practice in California, so it's imperative that you consult with a lawyer in your state if you're outside of California. So with that, we can begin. I'm going to do my best to basically give you a 15-minute summary of estate planning basics. And keep in mind, these discussions can go on for hours, but I'm going to just kind of give you the basic overview. So first question everyone wants to know, who actually needs an estate plan? Are you here? Is this going to be helpful to you? And the question is, the answer is really everyone. So a person should have an estate plan once they reach the age of majority. In California, the age of majority is 18. And the reason I say such an early age is estate planning is not just about your assets, it's also about your person. So what person means is your ability to make decisions for yourselves and for your dependents and for your children. For example, choosing where you might live, making medical decisions, things of that nature. So even if you literally have no assets, if you have $0, 0 properties, you still need to plan for the scenario in which you can no longer make actual personal decisions for yourself. Okay, so next, so now you know that you need an estate plan. So now the question is, what is an estate plan? And so what an estate plan is, it's a set of written documents that govern the treatment of your person and your estate. Okay, and your estate is essentially your assets in various circumstances. So you'll see the 4 documents that usually make up a comprehensive estate plan. And so remember, you're planning for your person and your estate. And when I taught at USF's, before I moved USF Law, I always taught my students the 3 phases of planning. So if you don't remember anything else, remember that you plan for your person and your estate, and you plan for your person and estate during your life, the event if you were to become incapacitated, and death. So remember, life, incapacity, and death. Most people skip straight to death in regards to estate planning, and basically, forget that they also have to plan for the scenario in which they lose capacity, and they also can plan for their lifetime while they're fully cognizant. So remember, you need some form of an estate plan if you're an adult, and you should certainly plan for your life, your incapacity, and your death. So the first question is, what does planning for life, incapacity, and death look like? First, every person that's 18 years or older needs a healthcare power of attorney. Now in California, you'll see that first document right there. That's called an advanced healthcare directive. In this document, a person will name an agent to act on behalf of that person and specify what action should be taken for that person's health if they're no longer able to make decisions for themselves due to incapacity. Or someone can do it while the person has capacity, it just depends. So that directive is going to instruct whether to provide pain medication for a person, or whether to donate organs upon their death, or whether the person wants to continue to live in their home if they don't have capacity. And so that's also where you can nominate a guardian for your children, because remember, you want to plan for your children's person as well. So that's one, advanced healthcare directive. Second is, if you have finances in your individual name, every person has to have a power of attorney for their property. So it's similar to the advanced healthcare directive, except the agent is now in control of the property held in the principal's name, the principal being the person who executed the document. So if the principal loses capacity, the agent can take control and manage the finances in that scenario. So this is planning for your incapacity. The third thing that you need is some form of a distribution plan. And that usually entails a trust, a will, but generally the best way to go is to have both. And I'll explain that later. This is the more commonly known estate planning component, but everyone needs a distribution plan. And that's going to direct how your assets are distributed after you pass away. And if it's a trust, it'll also outline how your assets that are in the trust are handled during your incapacity in your lifetime. So again, a will and a trust are those options. But you got to remember that everyone's estate planning needs are unique. All adults basically should have one, and the main 3 components are the healthcare power of attorney, that advanced healthcare directive, the power of attorney for finances, and that distribution plan, which encompasses a trust and a will. So the importance of estate planning, and there's plenty of reasons why you should have an estate plan. Allows you to determine who inherits the assets you worked hard for. Justin mentioned earlier about that holding period being forever. If you properly pass your assets to the next generation over and over, the holding period can actually be forever. So you could buy Apple at $1, and by the time your great grandchildren receive it, it's worth, it's limitless how much it might be worth. So there's plenty of reasons why you want to have an estate plan. It helps you avoid probate, which I'll explain. But next, I'll maybe explain the consequences of not having an estate plan. So again, I just want to drill down what I said before, the 3 phases: life, incapacity, and death. Life, incapacity, and death. So before I even explain what happens when you die without an estate plan, I want to explain what happens if you lose capacity without an estate plan. So if you lose capacity without an estate plan, meaning without the financial power of attorney and healthcare power of attorney or a trust, or designating someone, a conservatorship proceeding may be necessary. And so that's the most popular conservatorship proceeding is the Britney Spears case. That's what a conservatorship is. So it's basically a proceeding, a court proceeding where someone who you might not want is appointed by the court to manage your financial affairs and daily life. So this results in annual reports. Your business becomes very public. Your finances and daily activities of living and medical information are accounted for and filed publicly with the court. It's also very expensive, as the person appointed, who is the conservator, has to file annual reports and pleadings, account for everything. The conservator and the conservator's attorneys are entitled to fees from your estate for taking care of you and taking care of your assets, and their fees and their court costs are generally paid from your estate. So, but if you have a comprehensive estate plan in place, it's more likely that you'd be able to avoid that type of a proceeding. And so as adults in California, we basically have to designate who we want to make decisions on our behalf in most scenarios, or California will do it for us. So that's if you lose capacity without an estate plan. Now, if you look at the chart on the screen, if you die without an estate plan, you subject yourself to another court proceeding. And this proceeding is more commonly known. It's called probate. Now, we talked about the power of attorney for healthcare and finances. And the third component is that distribution plan. So most people think that their property will go to the state without an estate plan, but that's not really entirely true. If you die without a distribution plan, your property is in almost every scenario is going to go to probate, and your property is going to be distributed according to intestate succession, which I call intestacy. So you'll see the chart on the screen. And that's the default distribution plan that California makes for you if you don't act for yourself and create your own plan. So if you don't choose your beneficiaries, California will. And like I mentioned, every person's situation is different, right? So you'll see the default goes to spouse, children, grandchildren, parents, and then their children. And if there are none, then the paternal and maternal grandparents, and then their issue, their children, their lineage. But everyone's situation is different. You have blended families. So, stepchildren wouldn't receive under intestate if you want to make a gift to them. You might have charitable wishes. In some scenarios, adopted children that could miss out. You might be a business owner and need a business succession planning where you want particular people to handle the business. So without specifying exactly how you want your property to pass, that intestate disposition could have unwanted consequences. So that's something to keep in mind on that end. Now, probate. What is probate, right? And why do you want to avoid it? And so in a probate proceeding, the court appoints a personal representative to handle the probate estate, and the representative gathers and inventories the decedent's assets. So that person alerts all the known creditors, pays the creditors if warranted, has to account for the assets, and then transfers the property to the heirs and beneficiaries after petitioning the court for approval to do so. It's like a long process. Now, you'll keep in mind that there are probate assets and non-probate assets. So a lot of the assets that Justin mentioned, like the stocks and the bonds and cash and financial accounts, those are assets that are subject to probate. But you'll also have like your deferred tax retirement accounts like 401ks, IRAs, life insurance policies. Those are not subject to probate. So if you have no cash, but you have just all you have to your name is a life insurance policy, you just need to designate your beneficiary on that policy, and then that goes straight to that beneficiary, and then you don't have a probate. But if you have, $1 million in cash and stocks and bonds, then, and you have no disposition plan, then that's when you'll essentially be subject to probate. So just keep that in mind. Right. And so with probate, this is a lot of information crammed into a small time, but basically there's several downsides to this process. The main thing, it's slow because it's the courts, right? So many court processes are slow. Oftentimes it takes around a year or more to transfer the assets. I have probates that have taken multiple years due to unique circumstances, like 6 years, 5 years. Some have been going on for 20 years. The other disadvantage is that it's public. So the deceased person's assets and business will be put on display in the public court, kind of like the conservatorship that I mentioned. And all aspects of the administration will be reported to the court. And then one of the biggest things is it's very expensive. So millions of dollars in fees and court costs are lost every year from people's legacies to probates in California. And so, it basically, I'll just give an example. The personal representative gets paid, the attorney gets paid, and the calculation is based on the gross estate. So if the decedent has a house worth $1 million, and then you have a mortgage of $900,000, the fees calculated based on the $1 million amount, not the $100,000 in equity. So it's 4% of the first 100,000, 3% of the next 100,000, 2% of the next 800,000, and then 1% of the next 9 million, and so on. But again, the administrator and the attorney are getting paid that double. So in that scenario with the $1 million house, the fees would be probably around like 40 something thousand. And then also they can bill hourly for extraordinary fees like selling the house. So it just gets very expensive. So just keep that in mind. And then one caveat I'll say though is you can skip probate if you have assets of 166,250 or less that are subject to probate. You can do a small estates affidavit, which is a summary proceeding. But remember, we're trying to build wealth. So probably if you have 150 right now, you're hoping to have more than that. So you definitely want to do an estate plan. And so basically, we're going back to the disposition plan. The biggest question is when you create this disposition plan, what factors do you consider when trying to decide between executing a will or a trust? And so you're going to get tired of me repeating this, but remember, just keep in your mind the 3 phases of planning, which is life, incapacity, and death. And so a will, let's talk about a will. A will is a document that basically directs to whom and how you want your assets distributed. But a will only takes effect on death. So again, if you were to lose capacity during your lifetime, the will is not going to help. A will is also subject to probate. And there's a bit of a misconception that if I have a will, I avoid probate. That's not true. If you die without an estate plan, you are subject to probate and the default California laws of intestacy. If you die with a will, you're still subject to probate and have to go through that process, but your disposition plan is distributed according to the will, right? So, and you'll get to select whoever your personal representative is. So that's a will. So in California, a trust is generally the way to go. And what a trust is, it's a document that essentially holds your assets, excluding like certain ones, like a 401k would not go into your trust, an IRA would not go into your trust. The non-probate assets generally do not go into the trust. But the stocks, the cash, the bonds, those go into your trust. And so that trust governs the management, the use, and the disposition of those assets. And the best part about the trust is that it plans for all 3 phases. So because the trust basically, it takes effect immediately when you execute it. So I sign my trust today, it takes effect and it governs everything. And so, that's important because it's giving, the guide on what to do in those 3 phases. So also, if you have assets in your trust, on your death, they skip probate. So basically, I think I'm a little over time. So, that is basically the rundown. But there's certain drafting, like you'll have a different trust if you're married versus if you're a single person. And even if you're married, you'll have multiple different types of trust, depending on if you have a blended family and things of that nature. And that's something you want to consult with an attorney about. And again, like I mentioned, the power of attorney for finances, this is someone who's going to take care of your assets that are held in your individual name, but not in your trust. If you were to lose capacity, the advanced healthcare directive is the same, but except it's for your person. So basically, just to wrap up, if you have a trust, the assets are going to, those assets will skip probate. And so you just want to make sure that you properly protect yourself in that way. And that will also allow you to plan for your life, incapacity, and death, because the trust takes effect immediately. So if you didn't learn anything from this, this is the recap. Those typical documents that you want to have in your full comprehensive estate plan are your trust, a will, a power of attorney for finances, and advanced healthcare directive. The 3 phases that you want to focus on is your lifetime, when you have your full capacity, the event that you don't have capacity, which is incapacity, and death. Plan for all 3 phases. When you're planning, consider not just your estate, but also plan for your person. And just remember, who needs an estate plan? It's definitely you, unless you're under 18 years old. So that's my presentation. So if you want to find me, I'm starting at a new firm in Century City, Freeman, and Smiley, next Monday, September 27th. Here's the website. And yeah, it's been a pleasure just sharing a little bit of knowledge with everyone, and take care.
Thanks a lot, Kevin. Really appreciate it. I wanted to add a personal story to kind of basically reinforce what Kevin's saying. My mother summoned me to her home many years ago in March, and she said, I want to sit down and talk to you about my life. And I said, okay. So I met with her in March, and she opens a refrigerator and has a safe in her refrigerator. Apparently that's a safer place than not in the refrigerator. And she pulled out this binder, and in the binder was a advanced healthcare directive, right to die, power of attorney, living trust, will, everything. And she even recorded it in the county where she lived. And I said, why are you doing all of this? You're 63 years old. You're going to live like forever. September of that same year, killed in a head-on car accident with my uncle. Instant. Okay. 6 months. And I'm going to tell you something. She prepaid for her funeral. The only thing we had to do is we had to run an obituary, and we had to pay for the spray, the flowers that go on top of the casket. She took care of everything. But I'm going to tell you something. She had lots of property, and it would have been really messy. You got 4 kids, and it would have got pretty messy. And she had all of her affairs in order, and it was so smooth. And the only hiccup we had was scammers calling up saying, yeah, this is the bank calling. I just need your social security number. And they were trying to steal assets. So we called the bank, and immediately the bank shut it down, and so nobody could touch it. But it was crazy. But she moved everything, all of her property, her home, all of her properties, she moved into the trust. And it was so easy. I'm telling you, I mean, it's a tough thing to go through for anyone, but I got to tell you something, when your affairs are in order, they're in order. So me and my wife went out and we did the whole trust thing too. So it's really, really good. It's easy. The kids, we don't have to worry about it. And we put actually something in ours that my mother had recommended, but she didn't have in hers. And that's it. If anyone challenges the trust, you're out.
It's called a no contest clause.
Yeah, no contest. So that way there's no arguing between the siblings, you know what I mean?
Right.
Because we saw my aunt and uncle, and they had 6 girls, and they were fighting, and their husbands were going out and getting attorneys. It was really ugly, and they had about 15 million in assets, in that asset. So it was a feeding frenzy. The sharks were in the water, and we just saw how ugly that was. So, and that's why my mom went out and did that. But anyway, just wanted to share that story.
Yeah, Mitch, thanks for that story. And just like I mentioned, I handle estate planning, trust, and probate admin. administration, like, you know, the administration that Mitch just mentioned. And then also I handle litigated matters and disputes, and you'd be surprised. So when I'm drafting an estate plan, it's not a hypothetical scenario to me. I've done the administrations. I've been in the battles where we're fighting over $50 million in assets. And you'd be surprised what a good estate planning attorney, if they do a good plan, how that minimizes potential litigation. And when you're litigating over these assets, it's dwindling down the trust estate general. And so your legacy that you're leaving behind to, you know, your loved ones or whoever you want to receive your assets is going to get dwindled down. One, if you don't have an estate plan, or if you have a poorly drafted plan, or you haven't put your affairs in order. So the goal is to pass as much as possible to the next generation. And if you don't have your affairs in order, then, you know, you start to, the state or others might start to draw on those funds. So.
Can we ask questions?
Sure.
Oh, hi, everyone. So my question is, I had heard about someone who, they're probably worth maybe 100 million. And they were saying that they have a living trust that is in another living trust, that is in another living trust. I'm trying to understand what's the benefit of that. And then if you could also speak to generally what our expectations are in cost for developing a living trust, and, you know, also go through like the modifications of that as our wealth grows.
Sure. So cost-wise, I mean, every attorney is different, and every firm is different. Some firms, like the one I'm going to service high net worth clients, some do not handle that at all. Some handle both. And so the price is just going to depend on which attorney you're working with. So I can't give a price right now. You would have to speak with that individual attorney. I wouldn't want to give you a false price, but you know, because it does range. And so as far as you mentioned, there was a individual with $100 million or something like that. This is actually, I'm glad you raised that, because this is I think this is what causes the disparity in actually getting the plans. There's a difference between estate planning and estate tax planning. And so estate and gift tax is basically transfer tax. So if you transfer your assets to someone else on death or during your lifetime, you basically, the government will tax you on that, right? Like on the transfer. However, there's a high exemption amounts, which is as of this year, 11.7 million. So if you don't have 11.7 million or close to it, you might not need the estate tax planning, which are probably those trusts that you're mentioning. It's not a living trust and a living trust, but that's probably like too advanced for this discussion. But basically, you'll have like your foundational estate planning documents, and then you'll have other vehicles to basically get assets out of your estate. So if you have $100 million, you're trying to get down to 11.7, you might put, you know, some of your, first you start gifting, right? Like the exclusion amount, which is like you give like a $15,000 gift to your kids every year because you don't get taxed on that. So those other trusts are basically getting assets out of your estate. But if you're under 11.7 or, you know, or not close to it, then you want to basically just do a foundational plan and do your estate planning. But but like, you know, people with $100 million are basically trying to minimize the estate and gift tax. Did that answer your question?
It didn't, well, in some ways, and then it brought up another one. So can I give my kids each 50,000 a year, and then I don't get taxed on it, but then they would get taxed on it?
It's $15,000. So basically,
15. Got it.
15,
yeah, I got the 15.
Yeah, whenever you make a gift. So if I made a gift like of $100,000 to my you know, like a friend or something like that, I'm supposed to file a gift tax return. And so the estate tax when I die and the gift tax that I've made during my lifetime basically are combined on my death. And then if it's over that 11.7, which fluctuates, so it's supposed to maybe go down, then I get taxed on what's over, what transfers I've made over the exclusion amount. So if you're basically giving out, you know, a $10,000 gift to your children, that's an exclusion amount because you can do that under 15,000. You don't get taxed on that. And now that money is out of your estate. They don't get taxed on it either, as far as for gift or transfer tax purposes. But maybe if they, you know, then made another gift later and they had assets, then they get taxed on it. And I think actually you mentioned I think amendments. And so basically after you create basically you almost always want to have a trust. You can always amend the trust and change the provisions. So a lot of times people think of it creating their estate plan as like a final type of thing, but you create your estate plan. If you want to make a change, oftentimes you can with the foundational trust, which is a revocable trust. There's some trusts that are irrevocable where you can't change, but generally you're going to do a revocable trust. So if you want to change your mind in a year or 2 years, you can. But I think it's important to actually just get it done, at least that foundational document to start, and then you can start tweaking it. But some people wait 7 years because they just can't decide. So, but of course, it's always that person's decision.
All right. Thank you so much, Kevin. Really appreciate it. Are there any other questions?
Yeah, Kevin, can you comment on the value of trust, not for death, but for like incapacity planning?
Yeah, so circling back as far as like incapacity planning, right? So life, incapacity, death. That's like, if you just keep thinking about that. So on your death, if you have basically like a trust, the trust is going to tell you who's going to receive the assets as the trustee, et cetera, and who those assets are going to go to, which beneficiaries. Now, during your lifetime, you're the beneficiary of your trust. But if you lose your capacity, you are no longer able to manage your finances. So you can't act as what's called the trustee, the person with legal title to the trust. So if you lose your capacity and can't manage your finances, a new person that you've named steps in as the trustee and handles all of your assets in the trust for your benefit. So they're gonna, pay whatever, if you say you got into a car accident and you have no more cognitive function, whoever the trustee that you named is going to help you during your lifetime if you're in a home, in the hospital, in a facility, and pay all of those bills for you and make sure that you're taken care of financially. And so that's why it's important to have a trust versus like a will, because that trust takes effect immediately. And if something happens as far as incapacity goes, then you're taken care of, at least financially. With the Advanced Healthcare Directive, you'll be taken care of as to like personal decisions. So that's a phase that people sometimes gloss over because we just recognize death with estate planning, but it's also planning for your incapacity or, if you're living in a limited capacity. So.
All right. Thank you, Kevin. Thank you, Justin. Great presentation today. I'm going to turn it back over to Vernon. Vernon, take it away.
Justin, Kevin, really can't thank you enough for just an absolutely outstanding and informative presentation. It was great. I've learned a lot, taken many notes, and so I really appreciate you taking the time to meet with us. Our next Breakfast Club event is going to be October the 20th. The speaker is going to be Dennis Deutsch. He is going to be talking about how to grow your business. So we'd love to have you join us then. And again, thank you very much to everyone for joining us this morning. Hope it was working for you, because I know it was working for me. And enjoy the rest of your day. Have a great one, y'all.